This is not financial advice. This is for educational purposes only. Most financial systems are designed to perform best when the world is calm. Predictable growth, clear rules, trusted institutions. Bitcoin is different. Bitcoin does not require stability. It does not depend on trust, and it does not need calm conditions to function. In fact, Bitcoin often reveals its purpose most clearly when systems are under stress. I'm HODLHero, and in this video, we're going to examine why Bitcoin doesn't just survive periods of chaos, but often becomes more relevant because of them. Not as a speculative asset, not as a political statement, but as a monetary system designed for fear, uncertainty, and institutional failure. To understand Bitcoin, you have to understand what happens when trust breaks down. Bitcoin did not emerge during prosperity. It emerged from failure. In 2008, the global financial system broke publicly. Banks collapsed. Governments intervened. Losses were socialized. Trust eroded. In that environment, the Bitcoin white paper was published, not as a reaction to a single event, but as a response to a repeating pattern. A system where money could be created without limit, where institutions were too big to fail, and where ordinary participants bore the cost. Bitcoin was designed without a central issuer, without discretionary control, and without reliance on trust. This origin matters. Bitcoin was not built to optimize comfort. It was built to function when comfort disappears. From the beginning, Bitcoin assumed failure as a baseline, not an exception. Fear is often treated as a market problem, something to avoid, something irrational, something that distorts decision-making. But fear also reveals priorities. When systems are trusted, people optimize for yield. They chase returns. They accept leverage. When trust breaks, those behaviors reverse. People seek safety, durability, control. Bitcoin becomes relevant not because it promises growth, but because it removes certain risks entirely. No central authority, no single point of failure, no discretionary supply expansion. Fear does not break Bitcoin's model. It activates it. Bitcoin is not a fear trade. It is a fear response. Over time, a pattern has repeated. During the Cyprus banking crisis, capital controls appeared. Depositors were bailed in. Bitcoin provided an exit. During global lockdowns and rapid money creation, confidence in monetary discipline weakened. Bitcoin adoption broadened. During inflation spikes and rate shocks, traditional portfolios struggled to adapt. Bitcoin found a floor. Each crisis exposed a different failure: custody risk, currency debasement, policy unpredictability. Bitcoin did not fix these systems. It simply existed outside them. That distinction matters. Bitcoin does not need crises to grow, but crises accelerate understanding. In calm environments, Bitcoin often appears redundant. Banks function. Markets are liquid. Institutions feel reliable. In those moments, Bitcoin looks slow, unexciting, boring. This is not a flaw. It means alternative systems are not currently being tested. But calm conditions do not last indefinitely. History suggests they never do. Bitcoin is not designed for ideal conditions. It is designed for failure modes. When chaos appears, priorities shift quickly. Yield becomes secondary. Access becomes critical. Portability matters. Final settlement matters. Assets that depend on intermediaries inherit intermediary risk. Assets that require permission inherit political risk. Bitcoin removes those dependencies. Ownership can be verified. Transfers can occur without approval. Supply cannot be altered. In chaotic environments, these properties stop being theoretical. They become practical. Fear clarifies value. Gold has historically served as a fear hedge, but gold is physical, slow to move, difficult to verify at scale. Stocks rely on functioning markets. Bonds rely on issuer credibility. Real estate relies on legal enforcement. Bitcoin relies on math. It is portable, divisible, globally transferable, and verifiable without trust. This does not make Bitcoin perfect. It makes it distinct. In fear-driven environments, distinction matters more than optimization. Institutions do not respond to fear emotionally. They respond structurally. When uncertainty rises, they reduce exposure to discretionary risk and increase exposure to durable systems. This is why institutional allocation often occurs quietly during stressful periods. Not during euphoria, not during headlines, but during reassessment. Retail often sells fear. Institutions absorb it. Not because institutions are braver, but because their timelines are longer. When fear enters the system, short-term participants exit. Long-term participants remain. Supply tightens, not because demand explodes, but because selling exhausts itself. Bitcoin's fixed supply amplifies this effect. Once coins move into strong hands, they tend not to re-enter circulation quickly. This does not show up immediately in price. It shows up in structure. Markets adjust slowly to new realities. As geopolitical tension increases, money becomes a tool. Sanctions, restrictions, currency weaponization. This creates fragmentation. In fragmented systems, neutral settlement becomes valuable. Bitcoin does not belong to any nation. It does not enforce political alignment. It does not discriminate. That neutrality becomes relevant when trust between systems erodes. Bitcoin does not replace states. It bypasses certain conflicts entirely. Fear is often dismissed as noise, but recurring fear signals structural weakness. When fear persists, people seek systems that do not rely on promises. Bitcoin does not promise stability. It offers predictability. In uncertain worlds, predictability becomes scarce, and scarcity creates value. Bitcoin does not thrive because people love it. It thrives because it removes certain fears entirely. Fear of debasement, fear of seizure, fear of exclusion, fear of arbitrary control. In a world built on trust, Bitcoin looks unnecessary. In a world built on incentives and power, Bitcoin looks inevitable. This is not financial advice.